Thanks so much for tuning into this conversation with Inox Wind. They've come out with a quarter wherein the execution was higher in the monsoon quarter than Q1. Yes, the revenue growth number much lower than what the Bloomberg estimate was, but on the EBITDA front, they've done much better. And even on the revenue front, it's about a 240% growth, if I'm not wrong, in Q1 on a YOY basis. Devansh Jain joins in to talk about how he thought or his views on the quarter and the half year gone by. And very interestingly, the guidance that they've maintained in terms of execution for FY24, which means that the second half promises to be a very strong execution half. Devansh, great having you. Thanks for taking the time out. Sum up the quarter. The interesting thing was that, yes, the revenues were lower than what the Bloomberg estimate were, but despite the monsoon season, the execution in terms of megawatts, much higher than Q1 as well. So sum up the quarter for us, please.
Hi, good afternoon, Nikunj. Pleasure to be back. Yes, it's been a fairly enthusiastic quarter for us. We've turned around after 5.5 years. What we guided for was we'll become EBITDA positive in Q1 and get to a break-even level. So happy to say that we've turned cash back positive, even though minutely in the sense that we've had a cash back of about 5 crores in this quarter. But if you look at it, given the fact that Q2 seasonally very weak, given tremendous monsoons across the country, we've grown at about 250% compared to the previous year's similar quarter. And again, in terms of even last quarter of this financial year versus this, we've grown about 40 odd percent. Having said that, I think I've gone on record to say every quarter should be better than the previous quarter over the next couple of quarters. And I think we're well on track to supply, execute, deliver. We mentioned that from Q3, we'll be supplying our new product, our 3.3 megawatt platform. And I think we're very well on track to start supplies of those turbines across multiple customers over the course of the coming few weeks. So all in all, a big quarter for us from the perspective that we've turned around after a long period, and 6 years of pain in the sector is not something which you can just wash away with one quarter of performance. But I think very strong growth visible in the sector. Our order books are very large, and I think we should keep ramping up as we keep moving forward.
Large and growing, I presume, the order books?
Very large. So I think
and growing.
I think we should hopefully be announcing a significant amount of orders over the coming few weeks into Q3 and Q4. We've got a fairly large order book at about 1250 odd megawatts right now. Gives us enough visibility for 18 odd months. So frankly speaking, you can't have a 3-year or a 5-year order book, which is firm. At best, it could be 18 to 24. And I think we have a fairly healthy order book.
Yeah, something that you referred to in the last time as well. And I'll quiz you on that. And I'll come to the second half in just a moment. Just a couple of things which have maybe some relevance for the second half too. Now, if I'm not wrong, lower cost and in some inventory liquidation, 15 odd crores if I'm not wrong, help your EBITDA performance in Q2. And EBITDA at 82 crores was much higher than the Bloomberg estimate of 30 crores. My question is, how much predictability, Devansh, do you have for this metric for the rest of the year?
So obviously, we've guided for execution in terms of that we intend to do about 500 megawatts this year and 600 next year, and we stick to that. We've not gotten into specifics in terms of margins. What we did say was this year is going to be a turnaround year for us. We are going to become EBITDA positive. We are going to become net profit positive, and I think we are toying on those lines. What we did say was in the next financial year, we hope to get back to our historical EBIT margins, which used to be about 14 to 15%. And I think we stick by that. I think there's no reason not to believe that with our new upcoming product of 3.3, I think we're fairly confident of getting there.
Okay. So safe to assume that while you will get some orders for 3.3, as you said, in H2 too, but because you are making that the pivot, the key crutch for the EBIT performance improving in FY25, some benefits of that will not be felt or might be felt in H2, but the real benefits come in FY25.
So, of course, you'll see that in H2 as well, because we'll start supplying our 3 megawatt in this quarter. Having said that, but if you look at FY24 as a whole, H1 has only been 2 megawatts, and you're going to see some more of 2 megawatts in Q3, Q4. Having said that, yes, you're seeing the turnaround efforts now in us becoming EBITDA positive in Q1, us becoming cash back positive in Q2. And, I can't spell out, but I hope people are smart enough to figure out where we are headed in Q3 and Q4. Having said that, uh, FY25 is naturally going to be a far bigger year from the perspective that we are primarily a 3 megawatt supply company in FY25, number one. Number two, our debt costs have come down drastically compared to the last financial year. Q1 came down, Q2's come down further. God willing, Q3, Q4 should keep coming down. What we also mentioned is in Q1 was that over the next 12 to 15 months, we are aiming to be net debt free. Now, God willing, if we're able to achieve that sooner than later, then effectively the interest cost, which was passive for us over these 5 or 6 years, virtually gets eliminated, which is then effectively all bottom line. So that's where.
But since that's below the EBIT line, I didn't mention that. But since you brought it up, let me just quickly quiz you on that as well. 29% downtick YOY and about 8-9% downtick QOQ, if I'm not wrong. One net interest bearing debt is 1170. Did I hear you say that there is a particular metric that you will reach by a particular time in the next 18 months?
Yes, we did announce that we want to be net debt free in the next 12 to 15 months. We said that in Q1, and I think we should be on track to hopefully achieve that.
Okay, great. Now the business, and first some basic numbers, then I want the slightly longer term numbers as well, because your investor presentation and the interaction that we did, Devansh, a couple of quarters back had a lot of those points too. So I would love to understand the macro, but first the basic numbers. 77 megawatts Q2, 66 megawatts Q1, and you maintained the guidance. So what's the execution path for Q3 and Q4? Is there some detailing that you can go into?
Look, I can't get into specifics, but yes, we've done about 150 odd megawatts, 143 to be precise in H1. Q2 is generally lean. Q1 was the quarter when we started ramping up after the sector coming back and us strengthening our balance sheet. So Q3 is going to be bigger than Q2, and Q4 is obviously going to be bigger than Q3. That's all that I can say. I think we have guided for about 500 megawatts in this year, so I see no reason why I need to change any of that. And I think we're well on track to hopefully achieve and beat whatever we are stating. Again, I think what's also important from our perspective is our profitability metrics is given. I heard you say whether the Bloomberg estimate in terms of the sales was down, but the profitability was much better. At the end of the day, it's all about profitability. So I don't want to be the largest player. I just don't want to keep doing business without making any money. We've borne the brunt of that for the past 6 years, and I'm in no mood to be in that situation again. So I think we are very, very focused on our profitability. We keep focus on sales, of course, but more importantly, it needs to be sensible sales, ease of execution, ease of cash flows, and sales to people who have the ability to be.
Got it. So here's my question. I hear you when you say that order books will be about 18 odd months, and you can look at numbers as a businessman from actual hard numbers for 12 to 18 to 24 months. Now, but at the same breath, presentation and your conversations on con calls, on analyst calls, on our conversation as well, talks about multiple triggers beyond FY25 too. Now, my question is, I mean, and then you speak about the demand arising from the green hydrogen ecosystem is over, and beyond that, the offshore wind tender is over, and beyond that, multiple triggers, multiple tailwinds. My question is, in terms of predictability, certainty, dependability of what will get transformed into order flows, into business for you as a company, what are those few, and how do they come into the realms of certainty, if you will, or into being, if you will, post FY25?
Look, fundamentally, the government has announced a clear trajectory of 500 gigawatts till 2030. Now, most importantly, what's driving renewables is the cost factor. Back in the day, we spoke about pref tariffs, or we spoke about, carbon taxes. We spoke about the future generations pollution, blah, blah, blah. I mean, all of that is very important. I don't mean to minuscule that. But fundamentally, in our country, what drives any sector is when it stands on its own feet without any subsidy element and without any clutches. And that's where renewables is reached, where renewables is the cheapest source of power. So if you look at the average power procurement cost of the country, we're at about 3.75 rupees per kilowatt hour. And that keeps escalating at about 6 to 9 paisa per year. That's for the past 15 odd years. Renewables today at about 3 rupees is the cheapest source of power. Now, what's going to happen FY25 onwards on the wind side particularly? We've seen multiple announcements from the government where they've said that they're going to do about 10 gigawatts of plain vanilla wind tenders every year. And there's going to be another 10 gigawatts of hybrid tenders every year. Now, in a hybrid tender, minimum one fuel source has to be 40%. So let's assume it's 5 gigawatts of hybrid wind and 10 gigawatts of plain vanilla wind. If you go back until 2017, historically, the peak the sector did was about 4.5 to 5 gigawatts. Now we're talking of a scenario where the sector is going to be 10 gigawatts plus. 10 gigawatts only from central tenders or for designated entities carrying out tenders, procuring the power and selling it to states. This excludes captive requirements, C&I requirements, the upcoming boom in the green hydrogen requirements from FY26. So you're looking at a scenario where wind could be very, very strongly north of 10 gigawatts a year, starting FY26 onwards. In that scenario, obviously, order books are going to swell. Businesses will scale up multiple times from this year's multiple times growth itself. How we would see that being actioned out is we're seeing in Q1, or if I may say so, in H1, we've had about 2.5 gigawatts of wind tenders being awarded. But what we've seen in H2 in the public domain, there's almost 3.5 gigawatts of plain vanilla wind tenders for which bids, RFQs, etc. in the public domain, and about 11 gigawatts of hybrid tenders. Now, obviously, all these need to be awarded over the course of the year, but these RFQs, RFS is already in the public domain, which means broadly, over the next 6 months, you should be seeing at least 7 gigawatts of hybrid and wind tenders being awarded. Now, naturally, in terms of order booking, that translates 6 months into it, because once you get once you win the tender, it takes a month or 2 months to get your PPAs in place, and then probably a quarter to get your financial closure before people kick in. But you'll see that massive trajectory as we move forward. Today, you're seeing a lot of order announcements because the sector's come back after 5 years. Otherwise, for the past 5 years, you were barely seeing any order announcements. I mean, we've announced significant orders. We hope to be announcing multiple orders across PSUs, IPPs, C&I platforms, and retail customers over Q3 and Q4. So I think as we keep moving forward, you'll see the sector continuously becoming larger and larger and larger.
Got it. And Devansh, I wouldn't want you to make a commitment, this, that, etc., but just trying to understand. The numbers seem very large. The opportunity size is very large. Let's say, even for the next 6 months, the tenders that you're talking about, and excuse me for not doing my homework, for trying and figure out where is it that you would have bid, etc. But are you in a position to share some details about what's the quantum of bids that you might have put in? You might not get everything, but still a broad number?
No. I mean, unfortunately, I'm unable to share that. But there are 3 or 4 PSUs under which we've participated. There are multiple such bids coming in which we will participate. That's on the PSU side. Having said that, there are multiple IPP and CNI platforms which are in final stages of discussion at this point in time.
Okay.
I mean, we don't have too much which we can take in at this point in time for next year's numbers or the following year's numbers and improve profitability. But, we'll keep ramping up as we move forward. And I think what I've said earlier is once we become net debt free, we will certainly increase operation scale. So let's get there. Then we'll probably take in more orders. We don't need too many orders at this point.
Sorry, yeah. So when is there a target that you have for when do you do this net debt free, by X quarter of the next year?
Look, we said in Q1 we announced that over the next 12 to 15 months we want to be net debt free. So if you take 15 months, it's going to be September, calendar year 24. But I think we should be able to do it much before that.
Okay. The other question, because I hear you say that there is only as much that you can take even now. But when I look at the performance and the expectations or the projections that analyst community is making of the free cash flow that you generate now, starting now or FY24, FY25, 700, 800 crores, so on and so forth, when do you envisage the need to put in some more large capex in order to take advantage of all of these opportunities, wind, green hydrogen, so on and so forth?
Look, again, just to reiterate, from a green hydrogen perspective, we're not getting into generation of green hydrogen.
Yeah.
We're simply green hydrogen is generated by using wind and solar for electrolysis to generate that power. So we're only going to be supplying turbines
Of
again.
course, of course.
Other group companies make fluoropolymers and electrolyzers, etc., etc. But that's got nothing to do with Inox Wind.
Of course.
Having said that, we have a manufacturing capacity of about 2 gigawatts. So we have no significant capex requirements. Our capex is going to be about 50 odd crores this year and broadly about 50 crores next year. That's about it. That's for increasing our mold installations for the new blades which we are launching. Other than that, I think we're very, very efficient in terms of our manufacturing plants. We've got about 2 gigawatts of capacity already built. So unless we get to 1800 megawatts, at which point in time we need to increase capacity. But again, just to remind, we set up 2 gigawatts of manufacturing capacity for about 750 odd crores. We don't need thousands of crores unlike some of our competitors. So frankly, debottlenecking this capacity on an existing 4 large manufacturing basis probably be taking probably less than that to double it to 4 gigawatts. So I think those are very large numbers. We're not even close to that at this point in time. But, the free cash flows, God willing, should be so large that this is not something which bothers us at all.
Got it. So just to get this clarity for my sake, you've guided to what? The guidance is 500 megawatts, right? And you're talking about the capacity being 4 times that. So effectively, you're saying that even if orders flow in a massive way in the next 3, 4, 5 quarters, and you double your execution from where you would be at the end of FY24, you're still a long way away from the need to put up capex. That you do it discretionary is separate, but the need to put up capex, you're still a long way away.
Oh, absolutely. You're absolutely bang on. I think barring the 50 odd crores we need this year and next year for our molds, for the larger 3 megawatt platform, there are no other capex requirements. It's all free cash flow.
Got it. Awesome. Just one update, because the street has wanted to know a lot about this, 3.3 megawatt turbine, and you've referred to this conversation with me as well, that in FY25 onwards you will primarily be known as that turbine manufacturer. You see orders, supplies starting in Q3 as well?
That's right. We've said that. We're well on track for supplying turbines from this quarter.
And that, in effect, improves your operational metrics as well, because that's a better margin product, I presume.
Well, obviously it's a better margin product because it's a far more efficient product. We didn't upgrade our 2 megawatt turbines. Had we upgraded them, we possibly would have made better margins on our 2 megawatt as well. But obviously, when the sector shut down, we had so much inventory, which our IPPs did not pick up, which was stuck around our neck. It's taken all this period to get, cleaned up with that, with all that inventory. And now that we're virtually out of that, we're down to the last 30, 40 megawatts. We saw no reason to upgrade our 2 megawatt. We thought it's far more relevant to launch our 3.3 megawatt platform. And hence, you see our margin significantly improving with our 3.3 megawatt platform.
Got it. I have 2 more questions, Devansh, before we let you go. I've taken about 18 minutes of yours. 2 more questions. One is, I forgot to ask this to you earlier when we were talking about debt, but Nani Virani is kind of linked to that, right? Because Inox Green then repays the debt. It impacts the console numbers as well. And you referred to it briefly in the past as well as in the call yesterday. Give us some details. When does this whole transaction finally get over? What will be the promoter's role out there? Because I believe it's an asset which even the promoter entities might want.
So we've announced that transaction. In fact, in the recently concluded board meeting, given there was an RPT, we've got the approvals. As many of you may know, we've sold 4 such SPVs in the past to Adani and Torrent. So we had a benchmark. We got a few term sheets for this. We were in discussions for this. But at the group level, we have large power requirements, and we're not doing any capexes at the operating levels anymore. So we're setting up a new platform at the group level. It's a C&I platform. Like I said, the C&I market is booming. We're setting up a new C&I platform. We're in discussions with a couple of large private equity firms. We're going to make that a large play where all the capacities will be set up for our captive requirements, as well as sell to other third-party consumers. So that's what's happening. The board has already approved the transaction for divestment of Nani Virani. We need to do an EGM and get those approvals, which we should hopefully be through within the next 30 to 45 days. And then it should take about 2 months to get the connectivity transfer and the debt transfer done. So all in all, I would say 3 to 4 months, which would be a normal, even if we sold it to one of the larger IPPs, it would take 3 to 4 months to get the banking transfer approvals and the connectivity transfer approvals. So sometime over the next quarter, this should be out of the way.
Got it. Now you sounding obviously very bullish, and rightly so, on the wind business per se. Inox Wind, IWL of course gets merged. I remember at the end of quarter 1, you said that you wish you could actually talk about the year immediately and not just talk about quarter 1. So it's showing in the numbers. It would be wrong to not talk about Inox Green as well briefly before we wrap up this conversation, because in that presentation you're talking about how much it benefits from some of the plans that Inox Wind itself has. So tell us a bit about how does that proceed second half, if you're in a position to say that, Devansh.
Look, that's a very straightforward. It's an annuity business, very, very predictable. So every quarter is more or less the same. I mean, if you look at it for the past 12, 13 years, we provide 1M services for wind farms, wind turbines. Once you sell a turbine, typically turnkey projects, people are enter into long-term contracts with you. And there's no reason for anybody to get into something non-core. Historically, we've been at about 50% margins in that business for the past 12 to 13 years. And I think we are there. The fleet is now at about 3.2 gigawatts. We continue to grow that both organically and inorganically. What we've also stated publicly is when we IPO'd last year, we had about 2.8 gigs. We said we want to increase this to 5.8 gigs. Broadly, let's say a 3 gigawatt platform becoming 6 gigawatt. We said organically we'll add about 1,500 megawatts over 3 years, and inorganically we'll add about 1,500 megawatts over 3 years. I think organically we should be doing far more than that given the huge momentum we're seeing. And inorganically, I think we're well on track. We've already acquired India's third largest unorganized, if I may say so, O&M provider, iFox, which are about 230 megawatts. We've scaled that up. That's north of 300, 350 now. And we are looking at multiple opportunities to pick them and add them to our fleet. We are really basically corporatizing the sector. So when in these 6 years, you've seen almost 30 plus players go bust, there's almost 9 gigawatts of assets out there, which are being serviced by mom and pop O&M providers or unorganized retail guys, if I may say so. We're just moving in and corporatizing it so that there's much more predictability in turbine performance, and that increases our revenues. I think, as I said, it's a niche business. It's a lovely business, free cash flow, small, not to the size of Inox Wind, but in a business where you make annuity returns without any debt, it's a lovely business to be in. I think gradually the market should start appreciating that, hopefully. It's something which was a tough IPO to do when the sector was in distress. But I think as I meet more and more people, everyone says it's a no-brainer. It's an annuity company. You'll make free cash flow. I say, yes, that's what I've been trying to explain for the past period. But, I suppose when sectors are down, the good becomes bad. And when sectors are up, everyone starts appreciating the true strength of a business. But that's a lovely business to be in.
Okay. And growth targets, of course, laid out in the presentation as well. Devansh, great having you. Thank you so much for taking the time out, and all the best with all the execution that you plan to do and the order wins. We look forward to the announcements on the exchanges.
Thank you, Neeraj. It was a pleasure chatting with you.
Likewise. And viewers, thanks for tuning in.